You're watching Worldwide Exchange from Europe, Asia, and the United States.
A lot going on in this market day. To talk about it all, joining us is Stanley Crouch, Chief Investment Officer at Aegis Capital. And I want to get your reaction first to what happened with this ECB LTRO.
Sure.
$529 billion. What does the U.S. market think about that? How are we going to react?
Well, we reacted positively right away, and then we sort of relaxed. So I guess it's still going to be sorted out. How it shifts sentiment is what's important. I think the first round of LTRO was seen as the beginning of this rally we've experienced. It was a catalyst because it took the liquidity concerns and mostly the refinancing concerns of the European institutions off the table. I think this round may be a little bit more, where's my carry trade? If I'm running a bank, I'm trying to find out, okay, I've got 1% money. How do I best utilize that and reflating, some of the losses that I've got? And I think Ross touched on it before. The short end complex is pretty good, but the longer end remains to be seen, because if I'm running a bank and taking 3-year money, I'm not really sure that I'm that comfortable going out to the longer parts of the curve, just because the volatility risk in the pricing of the bonds still exists. I mean, Italy's now with a 5 handle, but if it goes back to a 7 handle, that wipes out your carry trade very quickly. So I think that's a matchup problem. And then further, there's 2 other issues I see that's important. One, how much gets into the private market? It's just as opposed to just funding the sovereigns in a more orderly way. And then lastly, when these stimulants go away, when these synthetic interventions go away, can the markets function normally? And I would say that goes for the U.S. as well. It
certainly does. I mean, in switching to the U.S. and really talking about equities, we hit these key levels yesterday, perhaps 13,000, more psychological, but maybe on the S&P, that technical level, 1370, we're above it, just 29 points away on the NASDAQ from that December 2000 high. What happens? Are we going to continue to move up, or is it time for a correction?
Well, a lot of people have been calling for a correction for a while, and that's been supported, the call for a correction, from some of the underlying technicals, which have been very, very poor. Participation, a lot of the moving averages, some of the RSIs and such. But what's interesting is we keep going. We think that there's probably a little bit higher target to be made than a reasonable pullback, but then more rally into a high that we expect to be towards April. After that, however, we could see a very serious and significant correction that's sustained.
We're almost done, but I want to give you sort of the last thought here, Guy.
So I just wanted to ask you really quickly, Stan, we've seen a pretty strong correlation between U.S. high-yield bond markets and the equity side of things. And, even considering all the rally that has occurred thus far in 2012, we're still pretty bullish on the high-yield side of the equation. When you're talking about a call for a correction,
a quick 20 seconds, and we're almost done here.
Is that connection going to hold, or is it going to break down?
It depends. Are we correlated or not with risk assets? Because bonds will follow it.
And that's the question. I'm so sorry we have to finish. What a program. Thank you, everyone, for joining us, and thank you on behalf of Ross.